Hey everybody, and welcome to Strategy Now here at MarketStream.live. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. Let's take a look at a strategic approach that you can apply in this market. Now, if you're new, this is going to be something that might be a little bit over your head, but you can watch this video either on the MarketStream.live website, or you can go to the Facebook page as well as YouTube and check out this video. But this is an approach where you can take your market opinion and have a fixed risk type of opportunity, but it's a little bit different than what we would traditionally do, like just buying stock, buying calls, which are participating on the upside options, buying puts that will participate on a downside move. We're going to use what's called a calendar spread. Okay, and it's going to have a defined risk and a lower risk profile than buying stock outright, buying just a call or put outright, or shorting the stock outright, or versus doing a front month vertical for those of you that are more sophisticated. So let's talk about, first of all, what are the critical elements or setup components of a calendar spread. And you can see on the screen right now behind me that some of the critical elements are that your market outlook, slightly bullish, then you're going to be looking at a call calendar spread. If you're slightly bearish, then you could be looking at a put calendar spread. The other thing is that volatility is relatively low. For those of you that don't know what volatility is, or implied volatility, it's that forecast of potential violent moves in an underlying security that's being priced in by the options marketplace. Folks, it's an indicator of what the options marketplace is anticipating as far as big violent moves. The lower that number, the lower the implied forecast is that stock could move violently. If you see that it has a low implied volatility, and you can check out the volatility charts at MoneyBlock, where they have just a nice straightforward volatility chart, you can see that. Now, for those of you that are wondering, well, why would I use this strategic approach? Because you have a lower risk tolerance, or you have less capital that you want to put at risk, or you may not have a ton of capital to put at risk, but you have an opinion and you want to deploy it because you believe that your opinion statistically has a high probability of occurring. Your reward. Well, your reward is going to be limited if you're limiting your risk. All right? That's the trade-off of fixed risk, is you're going to give up unlimited profit potential. You expect that the stock is going to be close to or at the short strike price that you're selling and buying. Okay? And this will take advantage of time decay. This is a factor that works against you when you're long options, but it works for you when you're short options. So let's talk about, now that we've looked at the setup, let's actually take a look at what not only the general markets have done, what these stocks have done, and then we're going to jump in and show two ideas that we can actually play out. First of all, we're going to take a look at, remember, you have to have a sentiment, right? Whether you're bullish or bearish. We're going to take a look at the NASDAQ right now. And right now, just looking at this chart, you can see that the NASDAQ has been grinding at new highs. As a matter of fact, today you do see that the NASDAQ is up in the afternoon hours, and it's trading off of some of its best levels right here. It's well above its 20-day and its 50-day moving average. Now, a stock that I want to take a look at, just a tech stock, I pulled it up, is Splunk, SPLK. Now, the one thing about Splunk that is interesting is that unlike the tech index that has basically been trading over its 200-day average and really now consolidating, Splunk over basically the last couple of weeks pulled off, consolidated, is pull off again, and it's now in this area right here where either the bulls or the bears need to take control. What is this area? This is the 20 and 50-day moving average. Now, Splunk is trading up 26 cents today, okay? And I'm looking at this, and I'm seeing a short-term bearish trend in play. In other words, the short-term bulls, This is reflected in the 20-day moving average. They gave up their support level in that 20-day moving average. It's now holding up on its 50-day moving average, which comes 61 is the 20-day, 59.90 is the 50-day. A break below that 59, basically $60, 59.93 specifically. A break below there means that we could have a trend shift. With the potential bearish sentiment increasing now that it has broken the 20-day and is really challenging the 50-day, this is getting me to think that I might be slightly bearish. So I like to compare this also to an index, and we will actually take a look at the NASDAQ. Or, excuse me, the S&P 500. Let's look at the NASDAQ. Excuse me. So I'm going to compare, and I'm going to do the NASDAQ. Okay? And there is the NDX. It's the yellow line. And you can clearly see that the stock is now divergent from the broad-based index, the NASDAQ. So it's actually moving in advance. So even though the market has been strong and holding up and actually moving to the upside, Splunk has been diverting away, or is in other words non-correlated right now with the large cap tech index. That's another sign that maybe this stock is a little bit weaker than the market in general. So that's why I have a slightly bearish more than a very bearish sentiment. And plus the fact it's still above its 50-day moving average. So what do I do? Well, if I'm slightly bearish, I want a fixed risk type of opportunity, I jump in and I do one last technical analysis component. I take a look at the seasonality chart. You can look at that at MarketStream.live or on MoneyBlock.com. And right now you're seeing a forecast of lower, lower, and lower, and lower over the next 20, 30, and 50 days. You also see that the correlation coefficient is at 72%. That basically means that when you're looking at the current price action and the previous price action, basically back as far as 2012, that's when the stock started trading, there is a 72% correlation to the seasonality line and its current price action. That is a high correlation. Anything that's 70% or greater is a high correlation. And you can see this green line is calling in the month of March, right? Downside. Maybe a little pop in April, but then continuation down through May. So a calendar spread that's slightly bearish would want to take advantage of the more moderate term or midterm bearishness that seems to be potentially showing up in Splunk. So I'm going to buy a longer term put, and I'm going to sell a same strike, and I'm going to do these out of the money, put against it. So thinking about strike selection, we're going to go up, and I'm going to go to options, trade options, and I'm going to type in the symbol SPLK, and you can see that's Splunk. And I am going to change this to create my own. Now I'm going to scroll down here and I'm going to enable the Greeks, and I'll explain that in a second. So the option that I want to buy, I'm going to actually look out in May. And I'm going to look at an option that's out of the money. Stock's currently trading at $60. I think that the market's going to pull back, and I think it might challenge 57, 57 and a half. That's a 30 delta option, so that right now it has a 31% probability of being in the money at expiration. Now, a lot of you would say, whoa, Joe, that's not a real high probability. You'd be right. It's not a high probability, but you're going to see that I'm not just buying this option for $2.30 outright. I'm going to go into the April expiration regular monthly cycle, and I'm going to sell the same strike put, but that's expiring in May, or in other words, in 41 days. I like that sweet spot of 41, 45, or 50 days till expiration. And for that, I'm going to sell that. I'm going to collect about $1.25. That means that basically I could get this spread done for about $1.05, $1.10, right? And as a matter of fact, let's see, I could, I can sell these at $1.25, so that's about $1.05. Now, I have about a $26,000 account. I typically don't like to put more than 5% of the total account value at risk. In this case, because I am not completely bearish, and this is a type of strategy that will see its maximum profit potential at April expiration if the stock is at or right around 57.5. So I'm going to do 5 contracts. And remember, the price right now, I'll just pay $1.05. Now, typically, just so I could get it filled, typically I would probably work something in the 85 cents to 90 cents range. But let's review this order. So basically what I want to do is I am going to be buying to open 5 of the $57.50 puts. That's my core position. That's my bearish position. But to pay for or offset that purchase price at $2.30, I'm going to sell to open the April, which is the closer month strike put, same strike price, just different expiration months, and I'm going to collect $1.20. So basically, I'm going to try to do this for $1.05. So I'm going to place this order. You can see that debit. That means that my risk is $105 per contract, or basically about $525. Now you can see that I got filled, and then basically what I will do is I will manage the trade. I will either take profits when it's trading at right around $1.25 or $1.50. As a matter of fact, I will immediately, to stay disciplined, go into my positions page. I will find the filled trade. I will go in and click close position. I will say that I will close it at a limit of, I paid $1.05, so let's say that if it's trading at $1.60, good until cancel, I will close the order, review order, and place order. So that basically would be per contract about roughly with about 60 cents, 55 cents per contract, 5 contracts. That's around almost a $300 potential profit, not including commissions, if in fact I got filled at that level. So now I'm working that order good until cancel to close at $1.60 credit. That's how I manage the risk. Now let's take a look at one other calendar spread that's actually trying to take advantage of potential upside. Again, slightly bullish, right? And I want to take advantage of the fact that it might take some time, so I'm going to have to I want to sell some options and want to have some time to do that, about 60 to 90 days. So I'm going to again use a call calendar spread. Now I'm looking at the let's actually take a look at the Dow Jones. The Dow Jones Industrial basically been pulling off. Still today we see it's now down 29, down 30, well above its 20 and 50-day moving average. So the general market has been trending up. It's actually getting close to filling its gap that it had last week to the upside. Let's see how this plays out. But again, the market's been in a clear bull trend, now just slightly neutral to bearish. But again, I wouldn't say it's bearish until it breaks this 20-day moving average, which comes into play at 20,695 on the Dow Jones. Now, the stock that I want to look at is Altria Group. Spin off a long time ago. And you can see one thing, Altria has been moving, ticker symbol MO, just like the Dow Jones Industrial. Up to the upside, it's actually stayed stronger than the general index. You can see that right here. Above its 20 and 50-day moving average, so clearly this is in a bull trend. But if we do have a challenge, if in fact it starts to pull back because there's some uncertainty, maybe there's some negative news out, don't see any. As a matter of fact, I see quite a bit of positive news stories on MO. But the bottom line is that this would be the area that you would start to see that the bulls are challenged. I want to put a fixed risk, and I'm willing to give up reward for fixed risk, higher probability trade that takes advantage of a stock that's also has some low volatility. I also want to compare this to the Dow Jones, and so I'm actually going to take a look at how the stock has been performing against the Dow, and you can see the Dow has been going on down as of late, but this is consolidating and actually moving up to the upside. So this stock actually has some strength, even though there's some negative nature to the overall marketplace. So this one's actually holding up, best of breed as I like to call it. So what do you do with this particular strategy? Well, again, I'm going to go in and set up a Philip Morris or an Altria call calendar spread to take advantage of my slightly bullish opinion on the stock. And again, these are all just examples. And I'm going to scroll down take a look, and I will display the Greeks. Now, you could just look at the first strikeout call and put, and again, what range am I looking at? Well, the furthest out that I can, or the closest, is June, as far as giving me some time. The stock's trading right now at $75.99, so $76. I would look at one strike out of the money, which is the $77.50 calls. So I'm going to buy those in June. So that gives me some time. That's giving me about 3 months or 90 days. I'm going to sell the April $77.50 calls, and that's what I'm going to collect. 58 cents here and pay 154 here. So that means that I could do this roughly at around 96 cents. Looks to be the market. Let's scroll up. Again, I am buying the further out month. That is my opinion. If the market goes up and starts to challenge 77.5, which right now, between now and June expiration, about a 30% probability that it will expire by June above this. And it's about, we don't have to say about, it is a 31% probability in the month of April of being above. So it's a low probability opportunity, but if the stock does move, and this is one of those stocks that when the market is bullish, it will grind to the upside. If the market starts to get uncertain, this one could actually hold up quite well. And because I'm buying the June option, that gives me time to be right. The maximum profit potential is going to be if the stock gets to and stays at or around 77.5 into April expiration. Now, what price am I going to pay? I'm going to pay a limit, and that's a limit debit. So I'm going to buy, and paying basically about, let's say 94 cents, let's say 95 cents. I'm paying a debit. Now again, 5% of the total capital available or in the account or account value. You can use whatever formula you want to use, cash available, 5% of the total account value. I'm going to basically do 5 contracts. That's right now right around $500, and review the order. All right, so I am buying to open the $77.50 calls. I am selling to open the April $77.50 calls. Basically, my risk is the debit I pay, which is 95 cents. My max profit is up to basically 77.5. So if the stock rallies $1.50, I could potentially be filled. Now, right now it's not. It's trading right around 101. I want to just get this filled so that I can basically show you all how you can go in and do this and review the changed order and place the order. And now that it's going to be in the system, okay, it's replaced, we'll work it. If it's filled, then I'll go in and manage it. All right, folks, that is it right now for our strategy now as we were discussing calendar spreads. If you want to watch this video, go to MarketStream.live. Again, if you want to ask any questions, shoot an email to info@MarketStream.com, info@MarketStream.live, info@MarketStream.live. Thanks, everybody, and we will be back on at 3:30 Eastern Time where we're going to be doing Tech Talk. See you then.